Hey everybody, welcome back. Donnie Eisenhower here. Today, we're tackling one of the biggest chapters in pre-license, Chapter 11, Real Estate Financing. Now before you panic, just because this chapter says financing does not mean that it's all math. There are actually very little math in this chapter. But what the exam really wants you to know is loan types, financing documents, mortgage clauses, ratios, lending laws, and how financing actually works in real life. So today I'm going to simplify this chapter for you, explain the exam terms, and show you exactly what you need to know. In the description below is the worksheet. You can download it and follow along with this video and study it later. While you're at it, don't forget to click the like button and then subscribe to my channel. Let's jump in. Principal and interest. Let's start with the foundation of all financing. When someone gets a mortgage loan, they borrow principal. Principal is simply the amount of money borrowed. The amount of money borrowed. You buy a house and borrow $300,000. Your principal is $300,000. Now the lender is not loaning money for free. That's where interest comes in. Interest is the cost of borrowing money. The bank charges interest as a percentage. So remember, principal equals the debt. Interest, the fee for borrowing the debt. So the portion of your payment that goes towards the principal builds equity. The portion going towards the interest does not build equity. Let's talk about amortization of a loan. Most mortgage loans are fully amortizing. That is extremely important to understand. A fully amortizing loan means equal monthly payments, part goes to principal, part goes to interest, and loan balance reaches zero at the end. So if the balance reaches zero, it is fully amortizing. Now early in the loan payment, most of the payments go towards the interest. Later in the loan, most goes towards the principal. That's called amortization. Now compare that to a straight line loan, also called an interest-only loan. With a straight line loan or an interest-only loan, the borrower only pays interest during that term, no principal reduction. Then eventually, it may be a huge payoff at the end. Let's talk about a dangerous loan here, and that's called negative amortization. That happens when the payment is less than the interest that's due. So the unpaid interest gets added back to the loan, meaning the loan balance actually grows. That's not good. So let's talk about PITI and equity. PITI, you'll hear this a lot. That stands for principal, interest, taxes, and insurance. That's the total mortgage payment most borrowers make. Now let's connect that to equity. Equity is the difference between the property value and what is owed. For example, a home value of $400,000, you have a mortgage balance of $250,000. The equity then is $150,000. The more principal you pay down, the more equity you build up. So let's talk about discount points and par rates. This may be testable. Discount points are prepaid interest paid at closing. Prepaid interest paid at closing. The way that it works is if 1 point equals 1% of the loan amount. So if the loan is $300,000, 1 point would equal $3,000. Now, why would someone want to pay points? That's because it lowers the interest rate. Generally, each point lowers the rate by 1/8%. So for example, par rate is 6%. Buyer pays 2 points. Rate reduction 1/8 plus 1/8 equals 2/8, or you have 1/4 or 0.25%. So that minuses from the 6% and gives a new interest rate of 5.75%. So now let's define what par rate is. I just mentioned that. Par rate means 0 points, no lender credits, and no buy down. It's the lender's standard rate. So the lender's profit is called a yield. It's called a yield. So let's talk about loan to value. Loan to value, or you may hear it as LTV. Loan to value ratio, LTV, compares the loan amount to the property value. So the formula would be the loan amount divided by value equals the LTV. So let's say the house price is $200,000. The loan amount is $160,000. $160,000 divided by 20%, $200,000 is 80%. 160,000 divided by 200,000 is 80% LTV. That means that the buyer is putting down $40,000 to the house sale price and will give them 20% equity at closing. So let's talk about qualifying ratios. And there are 2 types of standard qualifying ratios. The first qualifying ratio is the conventional loan. And they look at 2 numbers: housing ratio at 28%, total debt ratio at 36%. Now FHA is a little bit higher. For FHA loans has a higher ratio of 29%, total debt ratio at 41%. The buyer must qualify under both. They may qualify under one, that's not good. They must qualify for both. Now here's the easy way to think about it. Housing ratio, that's the max housing payment they can afford. Debt ratio, that is the max total monthly debt that they could have. So remember, you do count for debt. You do count car payment, credit cards, student loans, alimony, and reoccurring debt. You do not count groceries, gas, utilities, or entertainment. So let's look at a quick example here. A buyer is applying for a conventional mortgage loan. The buyer earns $4,000 gross monthly income. The lender is using the standard conventional qualifying ratios of 28% for housing ratio and then 36% total debt ratio. The buyer currently has a $250 car payment per month, $190 credit card payment. So, questions. What is the maximum monthly housing payment the buyer can qualify for under the housing ratio? So what we do for the maximum housing payment, we do the $4,000 gross monthly income times the 28%. That gives us $1,120. What is the maximum total monthly debt allowed under the debt ratio? So we then take $4,000 gross monthly income times 36%, and that gives us $1,440. After subtracting the buyer's current debt, which is the maximum house payment where the buyer can afford under the debt ratio, so we have the $250 car payment, the $190 credit card payment, that gives us $440. Then we take the $1,440, that's the max debt allowed, minus the $440 monthly debt, that gives us $1,000. So would the buyer qualify for a home with a proposed PITI payment of $1,500 per month? Housing ratio allows for $1,120. Debt ratio allows for $1,000. So the answer is no. The buyer does not qualify because they fail the total debt ratio. So let's take a look at this a little bit deeper. The lender allows the buyer to spend up to 28% of their gross monthly income on housing. So that's where we get $4,000 times 28%, and that is $1,120. So the proposed house payment is $1,050. Since $1,050 is less than $1,120, the buyer passes on that housing ratio. The buyer does not qualify under the debt ratio because the lender must also consider other reoccurring monthly debt. So that debt calculation is that the lender allows for total monthly debt up to 36% of gross monthly income. So what we have then, we do the $4,000 monthly income times the 36%, that's the $1,440. Now what we're going to do is subtract that debt. Remember the car payment of $250, the credit card payment of $190, that gives us $440. So what we're going to do now is subtract that $440 from the $1,440. That gives us $1,000. That means the buyer can only afford $1,000 max housing payment under the debt ratio, but the proposed payment is $1,050. So since $1,050 is greater than $1,000, the buyer fails the debt ratio. The buyer fails the debt ratio. So let's take a look at a promissory note and a deed of trust. Borrower will sign two documents at closing. The first one is promissory note. This is the IOU. It contains the loan amount, the interest rate, the payment terms, and the promise to repay. So if you remember, note equals money. Note equals money. Only the borrower signs the note. Now we have a deed of trust. This is the security document. It creates the lien on the property. This document allows foreclosure. So a memory trick here is deed of trust, property security. The deed of trust secures the note. And in North Carolina, we are a title theory state. That means that the lender can use non-judicial foreclosure process. That means the lender does not have to file a lawsuit in court to foreclose. Instead, the trustee, which is a neutral third party, such as a title company or an attorney, they have the power to sell the property if the borrower defaults. The foreclosure can happen much faster than a lien theory state, meaning a third-party trustee holds legal title until the loan is paid off. Let's talk about acceleration and alienation clause. Acceleration clause, that is triggered by default. If the borrower stops paying, the lender can demand all money now. Think of acceleration, default. Acceleration, default. It accelerates the money being due. Now, what is most common is due on sale clause, also called alienation clause. Alienation clause. That is triggered by a sale or transfer of property. If the property transfers ownership, then the lender can call the loan due immediately. Alienation at sale. Alienation at sale. Both clauses mean bring all your money now. But remember, acceleration equals default. Alienation equals sale. Let's talk about foreclosure and defeasance. If the borrower defaults, the lender may foreclose. North Carolina primarily uses non-judicial foreclosure. That means the lender does not have to file a lawsuit. Now, one great vocabulary word is to understand is defeasance clause. Defeasance clause. That means once the loan is paid off, the lender releases the lien. You defeated the debt. Defeasance defeated the debt. Defeated the debt. Let's talk about conventional versus FHA versus VA loans. A conventional loan is most common, and it usually requires a stronger credit score, typically about 20% down to avoid PMI. PMI is private mortgage insurance. FHA loan, designed primarily for residents, usually has a lower down payment, easier qualification, and it's often used for first-time home buyers. FHA insures the lender against loss. The money itself comes from approved lenders, but not directly from FHA. Let's talk about VA loans, available to qualified veterans. Benefits include often no down payment and competitive interest rate. VA guarantees the loan, and again, the money comes from lenders, not from the VA itself. Let's take a moment and dive into federal lending laws. 2 laws to know. First one is the Truth in Lending Act, TILA, T-I-L-A, Truth in Lending Act. That requires disclosure of your loan cost, the APR, and the financial terms. RESPA, Real Estate Settlement Procedure Act. That requires closing disclosure. Borrower must receive the closing disclosure within 3 business days before closing. This is very testable. So before we wrap up, let's do a quick review and rapid fire questions. So let's jump in. Fully amortizing loan equals balance reaches 0. PITI equals principal, interest, taxes, insurance. Equity equals value minus debt. Discount points, 1% of loan amount. 1 point, 1/8 of rate reduction. Par rate, 0 points. Conventional ratios, 28%, 36%. FHA ratios, 29%, 41%. Promissory note, the IOU. Deed of trust secures the property. Acceleration, default. Alienation, sell. FHA insures loans. BA guarantees loans. Closing disclosure, 3 business days before closing. Everybody, thank you so much for being part of this Chapter 11 that I hope I simplified for you. This chapter can feel overwhelming because there are so many terms, but honestly, if you focus on loan clauses and ratios and loan documents, loan types, financing vocabulary, you're going to be in great shape for the exam. If this video helped you, like this video and subscribe to the channel, and share this one with 1 other pre-licensed students. And remember, don't just memorize this stuff, understand it. That's how you'll pass the exam and become a great real estate agent. Thank you for watching, and like always, if you have any questions, feel free to reach out. I am here to help you from licensing to close.